Imagine signing a mortgage so long that you might still be paying it off when your grandkids graduate college. That's not a dystopian joke, it's becoming policy. The proposal of a 50-year mortgage is being sold as the answer to America's housing crisis. The pitch sounds simple: stretch your loan, shrink your payment. It feels like a lifeline for millions who are priced out of homeownership. But is it actually a solution or a long-term trap disguised as help? Because while your monthly bill might drop a few $100s, you could end up paying the bank twice the cost of your home in interest and never truly own it before retirement. So today, let's break down the real numbers, the history, and the economic truth behind this controversial 50-year mortgage idea. And by the end, you'll know exactly who wins, who loses, and whether this plan is mathematically smart or financially dangerous. Most people assume the 30-year mortgage has always been the standard. It hasn't. Before the Great Depression, home loans lasted just 5 to 15 years, with massive balloon payments at the end. Owning a home was a luxury for the wealthy. When the housing market collapsed in the 1930s, the U.S. government stepped in with the New Deal. Programs like the Homeowners Loan Corporation and the FHA made the long-term, fixed-rate mortgage possible for the middle class. That 30-year structure democratized housing, but it also bound generations to decades of debt. Now, nearly a century later, the same logic is being stretched even further. Fast forward to today. Real estate prices are near record highs, interest rates hover around 6%, and wage growth has failed to keep up. Even a 30-year mortgage doesn't make the math work anymore. So the new idea is simple. If you can't make homes cheaper, just make the debt longer. A 50-year mortgage promises lower monthly payments, but does it really make homes affordable? Let's crunch the numbers. Take a typical home in the U.S. worth $400,000. With 20% down, you're financing $320,000 at 6.1% interest. Over 30 years, that's about $2,022 a month. Over 50 years, that drops to around $1,800. That's an 11% decrease in monthly payments, roughly $220 saved every month, or about $2,600 a year. But here's the catch. Over the life of the loan, the total interest skyrockets. You'd pay around $354,000 more in interest. That's money burned, pure profit for the bank. You save a little each month, but pay nearly double in total cost. If making the loan longer lowers the payment, why stop at 50 years? Why not 100? In theory, a 100-year mortgage would make homes incredibly affordable. You could own $1 million house for a few hundred a month. But here's the problem. Markets adapt instantly. If everyone can suddenly afford more, prices will rise until the payment feels just as painful as before. Cheap credit inflates prices. We've seen it with stocks, crypto, and housing. When debt gets cheaper, assets get more expensive. So a 50-year mortgage doesn't lower housing costs. It simply raises prices and extends debt deeper into your life. The only real winners are the banks and institutional investors collecting interest for half a century. Longer mortgages sound like help for the middle class, but in reality, they supercharge the portfolios of investors, builders, hedge funds, and large private equity firms. They can now sell homes at even higher prices because buyers qualify for bigger loans with smaller monthly bills. For families, however, the debt lasts longer than most careers. You're not buying freedom, you're renting from the bank for life. Still, there is one possible way to make the math work in your favor. If you truly understand the time value of money, a dollar today is worth more than a dollar tomorrow because over time, inflation eats away at purchasing power. If inflation averages 2 to 3% per year, then every future dollar you owe is worth a little less. That means paying later is technically cheaper in real terms. And if you're financially disciplined, you could use the smaller mortgage payment to invest the difference instead of spending it. You're saving $220 a month with the 50-year plan. If you invested that every month into an index fund earning an average 7% a year, you'd end up with about $1.2 million after 50 years. Mathematically, that beats the extra interest you paid. And if you had invested that in something with higher returns like Bitcoin, you could be talking about several $1,000,000. On paper, this looks like the ultimate financial hack. But that's only true if you invest every single month for half a century, never panic, never miss a payment, never sell early, and the markets cooperate perfectly. Real life rarely works that way. Life isn't a spreadsheet. People change jobs, have kids, face emergencies, recessions, pandemics. Theoretically, the 50-year mortgage favors the disciplined investor, but emotionally, the 30-year mortgage favors the human being. Because there's a finish line, a moment when the house is yours, no bank, no debt, no strings attached. That sense of ownership, that peace of mind, is worth more than any mathematical model can capture. Here's the truth. Neither a 30-year nor a 50-year mortgage solves the root problem. The issue isn't how long the loan is. It's that there aren't enough homes. If governments truly wanted to fix affordability, they'd focus on supply. By reforming zoning laws, speeding up permits, encouraging building, and preventing mega corporations from hoarding single-family homes. Stretching debt longer only hides the pain. It doesn't heal it. So next time someone says a 50-year mortgage makes housing affordable, remember, it doesn't lower prices. It just lengthens chains. For the disciplined few, it might be a strategic tool. For everyone else, it's another promise of help that keeps you in debt until the day you die. Think carefully, because sometimes the smallest monthly payment comes with the biggest lifetime cost. You're watching Express EconGeoFinance Insights, your fast track to understanding the forces shaping our economy, our money, and our future. If you enjoyed this breakdown, make sure to like this video and subscribe to Express EconGeoFinance Insights for more deep dives into economics, geopolitics, crypto, and global finance. And now I'd love to hear your thoughts. Would you ever take a 50-year mortgage if it meant owning a home today? Or do you believe shorter terms and higher payments are worth the freedom later on? Drop your answer in the comments below. Your perspective might just spark the next big discussion.